Tonight, a deep sense of unease is quietly spreading across the world's financial markets. The source of this anxiety is a seemingly routine event, an auction for $22 billion in United States government bonds. Normally, an event like this would pass with little notice. But these are not normal times. For weeks, experts have been pointing to troubling signs in the market, a rare combination of rising borrowing costs and a falling dollar that suggests something is fundamentally wrong. This upcoming auction is now seen as a major test. The big question is, will there be enough buyers for America's debt? And if not, what does that mean for the country's financial future? The concern on Wall Street is palpable because this isn't just about one auction. It's a symptom of a larger, more pressing problem. The United States government has a very large amount of debt, and it continues to grow. To pay its bills, from funding the military to paying for Social Security, the government constantly needs to borrow more money. It does this by selling bonds. The fear is that the world's appetite for this debt is shrinking. Financial leaders like J.P. Morgan Chase CEO Jamie Dimon have warned of a potential crack in the bond market, a stark warning that the system we rely on is under strain. This particular auction for 30-year bonds is especially important because it measures long-term confidence in the U.S. economy. When investors buy these bonds, they are making a bet that America will be financially stable for decades to come. Lately, however, that bet has started to look riskier. The yield, or the interest rate the government has to pay on these bonds, has been climbing to nearly 5%. A higher yield is like a red flag. It means the borrower, in this case the U.S. government, has to offer a bigger reward to convince people to lend it money, signaling that investors see greater risk. The outcome of this $22 billion sale will send a powerful message. If the auction goes poorly, meaning there is weak demand and the government has to pay an even higher interest rate, it will confirm the market's worst fears. It would signal that investors, both at home and abroad, are becoming seriously hesitant to fund America's spending. This could trigger a chain reaction, making all future borrowing more expensive and creating a cycle of debt that becomes harder and harder to manage. For this reason, everyone from seasoned traders to government officials will be watching the results very closely. To understand the current crisis, we first need to understand what U.S. government bonds are. Think of them as a formal IOU. When you buy a U.S. Treasury bond, you are essentially lending money to the federal government. In return for your loan, the government promises to pay you back the full amount on a specific date in the future. Along the way, it also pays you regular interest payments. These bonds are sold with different timelines or maturities, ranging from a few months to as long as 30 years. They are how the government finances everything from building roads and bridges to funding scientific research. For decades, these bonds have been considered the safest investment in the world. This reputation was built on the unwavering belief that the United States government will always pay its debts. The U.S. has the world's largest and most powerful economy, and it has never defaulted on its financial obligations. This incredible track record has made U.S. bonds the foundation of the global financial system. Central banks in other countries, large corporations, and individual retirement funds all hold U.S. bonds as a secure place to store their money, confident that their investment is safe. This trust has given the United States a unique advantage. Because everyone wanted to buy its bonds, the government could borrow money at very low interest rates. This made it cheaper to fund its operations and respond to economic crises. When financial trouble hit anywhere in the world, investors would often rush to buy U.S. bonds, a phenomenon known as a flight to safety. This reliable demand kept borrowing costs low and reinforced the U.S. dollar's status as the world's primary currency. This system has worked smoothly for a very long time, underpinning America's economic leadership on the global stage. But the situation today, in June of 2025, is showing signs of strain. The bedrock appears to be developing cracks. The old assumption that there will always be an endless line of buyers for U.S. debt is now being challenged. The government's total debt has ballooned, and the annual interest payments alone are approaching a staggering $1 trillion. This massive debt load is causing some of the world's biggest lenders to second-guess the safety of their investment, disrupting the very foundation that has kept the global financial system stable for so long. A critical part of this unfolding story is the changing behavior of major foreign investors. For many years, countries with large trade surpluses with the U.S., like China and Japan, used their extra dollars to buy massive amounts of U.S. government bonds. This was a mutually beneficial arrangement. It gave them a safe place to invest their money, and it provided the United States with the steady financing it needed. These two nations became the largest foreign holders of American debt. Now, however, they are noticeably pulling back, creating what analysts are calling a demand gap. China and Japan have been steadily reducing their holdings of U.S. bonds. There are several reasons for this shift. For one, there are growing geopolitical tensions. As the relationship between the U.S. and China becomes more competitive, China is less willing to finance its rivals' spending. They are also seeking to diversify their investments and reduce their dependence on the U.S. dollar. Japan, facing its own economic pressures, is also selling off U.S. bonds. This selling pressure from two of the biggest traditional buyers means the U.S. must find new lenders to fill the void, which is proving to be difficult. The problem is made worse by a recent decision from credit rating agencies. Moody's, one of the top rating firms, recently downgraded its outlook on U.S. credit. A credit rating is like a report card for a borrower's financial health. This downgrade was a formal warning to the entire world that investing in U.S. debt is becoming riskier than it used to be. It damages America's financial reputation and serves as a clear signal to global investors to be more cautious. When a country's credit rating is questioned, investors naturally demand higher interest rates to compensate for the added risk they are taking on. This combination of rising debt, reduced demand from key foreign buyers, and a formal credit downgrade has created a perfect storm. It makes it much harder and more expensive for the U.S. to borrow the money it needs. The government is now in a position where it has to offer sweeter deals, higher interest rates, to attract the necessary funds. This creates a dangerous cycle. Higher interest payments mean the national debt grows even faster, which in turn can make investors even more nervous, potentially leading them to demand even higher rates in the future. This is the debt spiral that economists have long warned about. This crisis in the bond market may seem distant and complex, but its consequences are very real and will be felt by families all across America. The interest rates on United States government bonds are a benchmark that influences almost every other interest rate in the economy. When the government's cost of borrowing goes up, so does the cost of borrowing for everyone else. One of the most direct impacts will be on the housing market. Mortgage rates are closely tied to the yields on long-term Treasury bonds. As bond yields climb, mortgage rates will follow, making it more expensive for people to buy a home. Beyond housing, the crisis affects the value of the American dollar. For a long time, the strong demand for United States bonds helped keep the dollar strong. A strong dollar means Americans have more purchasing power when buying imported goods, from electronics to cars to clothing. But as foreign investors sell United States bonds and move their money elsewhere, the value of the dollar weakens. A weaker dollar means that everything imported becomes more expensive. This leads to higher prices at the store, effectively reducing the value of every dollar in your pocket and contributing to inflation. The financial instability also poses a risk to jobs and retirement savings. A volatile bond market can easily spill over into the stock market, causing sharp swings that can erode the value of 401ks and other retirement accounts. Furthermore, if the government is forced to spend more and more of its budget just on interest payments, it leaves less money for everything else. This could lead to cuts in government spending on infrastructure projects, education, and social programs. Businesses facing higher borrowing costs and economic uncertainty may also pull back on hiring, leading to slower job growth or even layoffs. Ultimately, this situation threatens the economic stability that Americans rely on. The combination of more expensive mortgages, higher prices for everyday goods, a volatile stock market, and a tougher job market creates a challenging environment for working families. It shows how decisions made in the abstract world of global finance have a direct and powerful impact on our daily lives. The worry that began on Wall Street is now making its way to Main Street, and it affects the financial security of every household in the country. Faced with this growing crisis, the United States government must now consider its next steps, and there are no easy answers. One potential path is for the government to take serious measures to reduce its spending and get its budget under control. This would signal to the world that the United States is committed to managing its debt, which could help restore confidence and lower borrowing costs over time. However, this approach is politically very difficult. Cutting spending would mean making tough choices about popular programs, and raising taxes is almost always met with strong public and political opposition. Another potential solution is emerging from an unexpected corner of the financial world: cryptocurrency. Congress is currently considering legislation to regulate stablecoins, which are digital currencies tied to the value of the United States dollar. Major stablecoin issuers like Tether and Circle are already significant holders of short-term United States debt. Proponents argue that a regulated stablecoin market could create a massive new source of demand for United States bonds, potentially helping to fill the gap left by foreign investors. However, relying on this new market also carries risks, as a crisis of confidence in stablecoins could lead to a sudden sell-off of United States debt. The Federal Reserve, America's central bank, also has a role to play, but its options are limited. The Fed could intervene and buy government bonds itself to keep interest rates from spiraling out of control. This action, however, is essentially printing money to finance government debt, and carries the significant risk of fueling even higher inflation, which would further erode the dollar's value and hurt consumers. The Fed must walk a very fine line between maintaining financial stability and preventing runaway inflation, a task that is becoming increasingly difficult. This moment is a critical test of America's financial leadership and political will. The bond crisis of June 2025 is more than just a headline, it is a wake-up call. The path forward will require careful navigation and likely some difficult sacrifices. The decisions made in the coming weeks and months will determine whether the United States can stabilize its finances and restore global confidence, or whether it will face a prolonged period of economic hardship. For every American, the stakes are incredibly high, making this a story that everyone needs to watch closely.